myself. I'm from South Africa originally, if you can tell from the accent. And I've been living in Australia now for about 22 years. I was brought over to Australia by a company called Esprit, the clothing company, and I helped set up Esprit in Australia. So my background is finance, but I've got a very strong retail and fashion background as well. Now, after leaving Esprit, I did a lot of advice in Australia to the clothing industry. And this is what I found. As I said, I went around to hundreds of clothing companies. And every time I spoke to an owner such as yourself or your accountant, you all spoke one language. So business speaks one language, and I realized that the banking industry speaks another language. About 15 years ago, I had a vision to standardize globally the way business and banks look at numbers. I developed a technique which I branded Optimist. My system today, my process today, is being used by all the major banks in Asia. Every bank in Australia uses my techniques. About 200 banks in the United States. I've got about 20,000 PO, YPO type companies, and I've got thousands of accounting firms. We've got about 1 hour today. I'm going to teach you how the best CEOs measure their business, and I'm going to show you the way the banks approve deals as well. So I'm going to start today's presentation, and I'm going to end today's presentation the same way. Revenue is vanity, profit is sanity, and cash flow is king. We business love profit. Your bank loves cash flow. We business speaks Spanish, and your bank speaks Portuguese. Now, when I started my company about 15 years ago, I had no money. And a lot of people in this room are approaching me and they're saying they've got a cash flow problem. So when I started my company, as I said, I did not have the ability to go to the bank. Have any of you ever raised money through professional investors? So quite a few of you. And was it successful for you? Not successful for you? You're still buying them out. Now, only about 2% of people who apply and try and get professional investors are successful. It's much easier to get the bank to say yes. If ever you want to raise money through a professional investor, this is the formula. A professional investor will only invest in companies who can demonstrate they are a mover. So if you're going to try and approach a professional investor, the first thing you need to demonstrate is that professional investor is investing in a management team who's got a very strong track record. So your management team has done this before. You've managed in good and bad times. The next thing you need to demonstrate to your professional investor is the opportunity. People will only put money in organizations who can demonstrate they've got a competitive advantage. Your company has got a lot of blue sky. You've got a lot of barriers to entry in your industry. Once you demonstrate your management team and the opportunity, the next thing the investor looks at is your valuation. If you believe your value is up here and the investor believes your value is down there, it's very difficult to do a deal. But if your valuations are fairly close, there are techniques to structure your deal. If ever you're going to get someone's money into your business, show them how they're going to get their money out. Every single investor who puts their money into your business is asking themselves, in 3 to 5 years' time, am I going to exit this business? And if I'm going to exit, will I get the right return? What type of return do you think a professional investor looks for?
10 times more.
So what percentage per annum? If I'm going to invest in your business, what return am I looking for?
Minimum 30%.
At least 25% minimum. If you are a startup company, people want 50% for a startup and 25 plus for a going concern. And this is why I say to people, if you cannot get money from the bank, most companies you walk into are not movers. And if you're not a mover, the last stage, you cannot structure a deal. I will give you my opinion afterwards. I am much more in favor of dealing with a bank compared to getting professional investors. This is a very risky concern, and I can tell you most people who do raise money this way end up crying. And dealing with a bank can be much more pleasant. I was quite lucky. In Australia, I was backed by the wealthiest family in Australia. My idea to create a global standard, to look at numbers, the wealthiest family in Australia came to me and they said, we want to back your idea and we want to take this idea globally. Are there any Australians in the room? Have you heard of the Smorgon family? Yes? So I was backed by the Smorgon family in Australia, and they have made billions of dollars. This was the email I got on the first day they invested in my company. They said, we have been very successful. This is our philosophy in business. 2 heads are better than 1. Everyone has the right to be heard in a non-threatening way. The truth will be told. Our word is our bond. The needs of the customer come first. There will be no surprises. Put the uncomfortable issues on the table. Promote teamwork and leadership, and be proactive corporate citizens. Now, ladies and gentlemen, I sold my business about 2 years ago. I did very well. I'm now dedicating most of my time to educating business leaders around the world how to run a better company. What I learned from the Smorgons, every company you walk into, the owner loves to give you the good news. It's all about, we had a great meeting, or things are looking positives. The Smorgons taught me to start every meeting with the bad news. And they said, 2 heads are better than 1. If we've got a problem in our business, 2 heads are better than 1. We will solve the problem in a non-threatening way. However, if you know there's an issue, or your staff know there's an issue, bring it to the table, because we hate surprises. And I'm going to show you later on that the banks hate surprises as well. David Smorgon, my business partner for 10 years, said to me, Alan, if you aim for the moon, you might make the sky. Keep trying. Write things down in black and white. The dream, the business plan. Get the right people into the organization. The backbone people, not the high flyers. No substitute for hard work. And always back your own judgment. Today, I'm going to choose an EO company out of the United States. Yes? Absolutely. So in other words, a lot of companies like to hire individuals with a great track record who are the executive team, who like to give advice. But what the Smorgon said to me, find the workers, find great people who are prepared to do the work in your organization. Don't always go for the high flyers. very difficult to find good people who can take your opportunity. The case study I'm going to do with all of you. Hopefully I'm going to show you what you do not know about your own business. Gary Furniture is based in Los Angeles. Gary is an EO member, and Gary tells us his business is doing fantastically. And Gary says, I import furniture out of China, I distribute to over 500 stores, and these are my financial statements. So Gary says, over the last, can you all see the numbers? So Gary says over the last 2 years, revenue went from 35 to 42 million. Gross margin grew from 10.5 to 13, and earnings before interest and tax grew from 3.7 to 4.6 million. Revenue is vanity, profit is sanity, cash flow is king. We business love profit, and your profit is an opinion. You can manipulate the profit of your company. Your balance sheet is an opinion. You can change valuations. The only fact in a company is their cash flow. Ladies and gentlemen, Gary Furniture believes he's doing brilliantly. Please, can you tell me Gary's cash flow in the current year? So between 2010 and 11, everything has improved. I'm asking you a very simple question. What is Gary's cash flow in the current year? And do you believe Gary's bank is happy with him? So I want the dollar value of the cash flow. There's absolutely no tricks to this question. What is Gary's cash flow?
Yeah, sure.
All the liabilities are higher.
There are much higher liabilities.
Yeah.
Every number is there that you can see the cash flow. So the question is very simple. Revenue, margins, and profit have improved. I'm now saying to Gary, tell me about the only fact in your company, your cash flow. And I'm asking you, EO, business leaders, every one of you receive financial statements on a monthly basis. Tell me the cash flow of this company.
I think the first 2 points, the accounts receivable and the inventory maximum could be, because the inventory is something that is going to be.
I'm asking a question, what is the dollar value of the cash?
Could be 14.
What is Gary's cash flow? I'm not asking for a reconciliation. Tell me the dollar value of the cash flow. How much? 42 million. So Gary's, but so between 2010 and 11, how much cash did this company produce or absorb?
So 22 minus 12, 10 million. About 10 million
So 10 million positive or negative?
positive.
So the first answer I'm getting is plus 10 million.
Minus 5. Minus 5.
Minus 5 million.
Accounts payable. Receivable, payable, currently accounts.
Plus 2 million. Let's get one more answer. Minus 7 million. Now all I can say to you is this is happening in your company every month. I'm asking the most simple question, what is the cash flow? And this is what I've got in the room. I've got business leaders from all over the world giving me completely different interpretations about the same business. Who in this room has got no financial training? So you will give me terrible seat.
हाथ खड़ा कर तू तो फाइनेंस का आदमी है
मेरी जो ट्रेनिंग है
बैठा है तंबू बना बना के दे
Sarah a question with no trick.
तंबू बना बना के
Sarah,
नहीं पता क्या लोग कितना
you start the year with $10,000 in the bank. You end the year with $1,000 left in your bank. What's your cash flow, Sarah?
1,000.
So I've said to Sarah, she's got $10,000 in her bank at the beginning, and she's only got $1,000 in her bank at the end. Sarah, what's your cash flow?
9,000.
Sorry? What is Sarah's cash flow? Minus 9,000. Cash flow is the easiest number to calculate. Cash flow is your movement in your bank borrowings. I can go to any company and in 1 minute I can calculate their cash. Gary Furniture, your short-term borrowings grew from 5 to 7.2 million. Gary's borrowed 2.2 million short-term and 1 million long-term. Gary has borrowed $3.2 million from his bank.
More.
He's got a negative cash flow of 3.2 million. Cash flow is your change in your borrowings, including cash at bank. So it's the movement in your bank balance. So if you're getting more money into your bank, it's either good or bad. So it's the movement in your bank, your borrowings, and your cash at bank.
But that depends on the cash that you utilize for the business, or you utilize that cash for the fixed investment or for creating more fixed assets. So isn't that's just a very simple way of calculating your cash flow? But what about the money you spend on your fixed assets?
I'm not looking for a reconciliation. The question I asked to everyone in this room is, what is Gary's cash flow? I will reconcile it for you later. However, today I'm going to teach you 3 cash flow definitions that are critical to every CEO in every country. The first cash flow definition is change in borrowings, and that's called net cash flow. So that's after everything has happened in your business. What's your cash flow? I asked you a second question. What do you believe the bank is thinking about Gary? This company, EO, told me he's doing brilliantly. What do you believe the bank is thinking? The bank's scared, insecure? What does every bank around the world look at?
Cash flows.
Every bank around the world, in every country, looks at one thing. Gary Furniture, you owe us, Gary Furniture, $17.2 million. Gary, do you have future cash flow to service your interest and your maturing debt? Can you repay us? The last thing a bank wants to do is to sell up your business. Gary is in the hospital division of a bank. And this is what is absolutely obscene, that we business believe we're doing well and the bank believes we're doing badly. And I can tell you in almost every case the bank is correct. Now, I don't have a lot of time and I'm going to teach you Spanish and Portuguese. We speak Spanish, the bank speaks Portuguese. A good storyteller, a good CEO, what you would say if you're a good CEO is cash flow is the result of growth. Gary has borrowed $3.2 million from the bank, and Gary's revenue has grown by $7 million. Gary, are you borrowing this money to grow your business, or is the bank giving you money to fund wastage? So whenever you think of your cash, you need to say to yourself, what is the quality of my cash flow? Is my money funding my growth, or is my business requiring money to fund management? And I've heard a gentleman give me a few interesting answers. Is the bank funding your inventory growth, your slower collections, your margins dropping? So whenever you think of the cash, say to yourself, where is my cash going? Is it going to fund growth or wastage? Now, I must say, this talk that I'm doing, I've summarized it into about 1 hour. However, if I come to your chapter, I'm cramming a 1 hour program here. It should be at least 3 hours with presentations. So if you don't understand my accent or you want to ask questions, just shout, just let's go for it. So as I said to you, this is the definition of Gary's cash. It's the change in his borrowings. I will also email all my notes to EO, and you can get a copy of all these notes. Now, whenever I walk into a business, this is the way my thinking goes. I compare a company to a funnel. Driving any business is their strategy. Yes?
I'm sorry, the previous slide, don't you have the changing cash? Well, the cash is sitting there.
Sorry, let me give you a microphone. I'm going a bit deaf. Is there a floating microphone here?
On the previous slide, don't you have to look at the changing cash as well? Because,
Gary's got no cash.
okay, so the 0 and 0. Okay,
Yes, but
then it makes sense.
But your answer
it could be
is yes.
sitting there.
Absolutely. If he had cash, totally correct.
Okay.
I'll have to bring it into account. What is the role? Yes. I'm scared now. I'm coming here. I thought this looked sexy. Sorry about that, guys. I was told to cut my shirt in, and I'm obliging. Thank you very much. Okay. Whenever I look at a business, I'm thinking of what should finance measure. What is the role of finance in a company? So any business looks like a funnel, can be compared to a funnel. Driving your business is your strategy. Does your strategy give you a competitive advantage? We then look at marketing. I then focus on operations. How does operations support marketing? How do we create innovation? How do we measure our people? And the role of finance is to measure your funnel. That's what finance needs to be doing in your business. So, ladies and gentlemen, a question to all of you. How do I know what is a financial measure to measure strategy? How do I know that Gary's strategy is working? What are some financial measures that you can use to measure your strategy? So current assets, return on assets, absolutely. Any other suggestions?
Cash flows.
Working capital. Okay, working debt to capital. Debt to equity. There's no right or wrong answer. You know, what I focus on when I look at in a business, two measures that I'm really going to focus on today is the concept of cash flow and what the gentleman there said, the concept of return.
Flow.
Now, when you look at a set of accounts, typically a set of accounts are quite complex and difficult to analyze. In one sentence, you can explain any business. So one of the things that I really emphasize to a company is to understand in one sentence what a business looks like. And the way I structure it is debt plus equity. So how can you finance your company? Your funding. And funding equals operations, net operating assets. So in one sentence, I can sit down with Gary Furniture and I can say to Gary, let me explain what your company looks like. So Gary has got debt of 7.2 plus 10. Gary's got
17.
$17.2 million of debt. Gary's equity in the company is 9.5. So Gary, we are giving you, the CEO of this company, 26.7 million to manage. So in any business, when you're looking at your own company, have a look at your business like this. Funding equals operations. I said to you earlier, what do you believe the bank is thinking when they look at Gary? If I'm the bank and I'm Gary, I would say to Gary, Gary, do you realize for every dollar you've got in your company, the bank's invested too? So it's very important to put the bank right next to you, because the bank is your partner. The Smorgans hate surprises. The bank is no different. Gary Furniture, you better keep your bank totally informed what's going on. Because if your bank gets a surprise from you, I can tell you now, it's not going to be a pleasant experience. So Gary, we have given you $26.7 million. And that $26.7 million is represented by receivables, 8.6 million. Gary's got inventory of 14.2 million. Gary's got fixed assets of 9.5. And Gary's suppliers are giving him 5.5 million assistance. This is Gary's business. If I was on the board of Gary's company, what do we want from Gary? What do we want from every one of you? We've given you a lot of money to play with. How do we know you're doing a good job? I want to get a return. The reason every company goes into business, some people call it return on capital employed. Some people call it return on net assets. The theory is called DuPont, taught at every university around the world. And why is DuPont such a beautiful financial ratio? Ladies and gentlemen, what is more important, your profit or your balance sheet? Put up your hands for those who say profit. So when you look at your financials, what's more important? So put up your hands for those who prefer the balance sheet. So I've got a whole lot of people in this room who are profit lovers, and I've got a whole lot of people who are balance sheet lovers. Why has DuPont become the global standard as a performance measurement? The formula for DuPont is very simple. It's earnings before interest and tax divided by net operating assets. So Gary, we have given you 26.7 million. You, Gary, have converted this into 4.6 million profit. Gary, you're making a 17% return. What is more important, your profit or your balance sheet? The DuPont formula. The reason you're going into business to get a return is EBIT divided by net operating assets. The same formula is EBIT divided by revenue multiplied by revenue divided by net operating assets. Revenue cancels out. So Gary, you've taken 42 million of revenue and you've generated 4.6 million profit. Gary's getting 11% what? What's that called? What is EBIT divided by revenue called?
Profit.
It's your profitability. So Gary, you're getting 11% profit, and Gary, you have taken 26.7 million and you've generated 42 million of revenue. Gary's getting 1.6 what? Asset turnover. Barry's converting his balance sheet into revenue 1.6 times. What I'm preaching around the world is if you want to make money, not only do you need to be a profit expert, but you need to be a balance sheet expert as well. Profitability management multiplied by balance sheet efficiency gives you return. If you are a good CEO and you are creating performance measurements for your business, not only do they need to be profit measures, but they need to be balance sheet measures as well. If you are a great CEO, what you need to do is to grow your profit faster than you're growing the balance sheet. This is what any good CEO needs to do. In Australia today, I'm on the board of quite a lot of companies. I draw this in every board meeting. If I was in Gary's board meeting on the 31st of December 2011, this is what Gary's business looks like. Gary, you've invested 26.7 million in your balance sheet and you've converted that into 4.6 million profit. Gary, as at today's date, you're getting 17% return. This is your business summary. And I would then say to the management team, tell me about 2012. What is going to happen? And if Gary says to me, we are doing very well and we're going to continue to grow, Gary is telling me he will move in direction C. So Gary, as your profit grows, your balance sheet grows. As your balance sheet grows, you're going to have to go to your bank to finance it. And do you realize, Gary, every dollar you're putting in, your bank's putting in too. So you need to understand what's the impact of growth on your funding and is your bank informed. The check signal of a good CEO is can you grow profit at a faster rate than you grow in the balance sheet? I would be asking Gary's board, can we grow in direction B? Is there any chance, Gary, of us growing our profit without needing to increase our balance sheet? Can we be absolutely ruthless on our receivables, on our inventory or our work in progress, on our utilization? Is it possible? Or Gary, is it possible to adopt a slash and burn approach? Can we grow profit on a shrinking balance sheet? Hopefully Gary doesn't tell us he's going to budget for the same profit, but he needs more money. Or Gary says, let's budget for lower profit and growing investment. Finance is measuring your business. Finance tells you, is your strategy working? Which direction should your company be moving in over time? A is optimal, but it's very short term. It's optimal. Anywhere between C and B is where you want to be. In the businesses I'm involved in, every 3 months, it takes me 30 seconds to calculate. I'll calculate the DuPont measure and I'll plot it. And then I'll show the company, is our strategy working? Are we moving in the right direction? So absolutely easy to do, but the concept is, as CEO, we need to become a storyteller and an expert storyteller in the profit and the balance sheet. Now, most companies I walk into have got the 80-20 rule. Nearly every company, who of you in this room have got the 80-20 rule? 80% of your revenue is 20% of your customers. So most of you. Gary Furniture has got the 80-20 rule. Gary Furniture. We've got to find ways to grow profit and shrink the balance sheet. So the first thing I do when I walk into a company is I sit down with the company and I say, let's look at your customer base. Gary, do you have a group of customers we love, we want to deal with? Gary, do we have a whole list of customers who are not critical to us? I then put the customer's hat on and I say to Gary, which customers love us, they want to deal with us, and which customers are not loyal? 1, 2, 3, 4. 80% of your revenue are the ones and the twos, 20% in number. 80% in number or 20% in value. What do you do with segment 4 in your business? So these are people who are not important to us and they don't consider us important to them.
Make it as small as possible. Like,
Make it as small as possible, absolutely. Exactly what I do. Every time I identify a 3 and a 4, I put up their prices. So I increase prices slightly and I make very strict terms of trade. If you are a 3 or a 4, and people often say to me, if I put my prices up by 1%, or if I make people pay me quickly, they're going to leave us. And my comment to every business, if you cannot explain your value proposition, everything goes back to price and payment terms. So companies who have got no competitive advantage cannot do this. But if your company has got a competitive advantage, you will not lose customers. I never like losing customers. But you've got to increase your profit and you've got to shrink your debtors, your actual accounts receivable. Yes, sir.
So what you're saying, if you don't have a competitive advantage, you're screwed.
Now, if you don't have a competitive advantage, you will always give a reason why you can't do it. So every company who I walk into says, we can't do this, I show them that they've got nothing magical. When I had my company in Matrix, we sold to 22 countries. We had over 20,000 users. I dealt with banks, who were a major part of our revenue, and a myriad of small business. I would never sell my software or my service unless the 3s or the 4s pay me in advance. I never had $1 of receivables, and I always put my prices up to these people. We never lost a client. And then what I say to the owner. The other thing you need to be careful of, Gary, is make sure your overheads are not down here. Make sure that your cost structures in your business are up here. Spend your money on the 1s and the 2s, not the myriad of small business.
hold on a moment. Can you explain better we love them all critical?
Sorry, say that again?
Can you explain better what customers are we love them not critical?
So these ones here, customers we love are customers who we believe are important to our business. They're a big share of our revenue and they've got a lot of growth potential.
And not critical?
Not critical. If I'm an accounting firm, for example, it's the mom and dad tax return. These are people who, if we lose them, it's no difference at all. It's not going to impact my company. I never want to lose a 1 or a 2. Whenever you've got a major customer, whenever I've got a 1 or a 2, I go to the major customer and I say to them, if I was dealing in Malaysia and I was dealing with Maybank, for example, who's the big bank in Malaysia, and I was selling them technology, I would say to them, Maybank, you are very important to my business. Which other software vendors do you deal with? Who's the best software supplier in the world do you consider? Tell me what we need to do, Maybank, to become your number one supplier. Tell me what I don't know. And then I would say to Maybank, Maybank, I deal with 200 banks around the world. Some banks are very easy to deal with. Can I tell you what you need to do for us to improve my relationship? So any major customer, make sure you have defined very clearly the changes that we need to make and the changes they need to make, and then how do we lock each other into our business? How do we develop a supply chain agreement? Now, if I was going to come into any business in this room on a monthly, quarterly, annual basis, and we were going to discuss only numbers, what would we talk about? So if I was going to come into Gary Furniture's company every month, and I want to create a process to look at numbers, what would we look at? What would we discuss? So cash flow and return. Now I'm saying to you today, ladies and gentlemen, every one of you need to become a storyteller. A story of numbers consists of 4 chapters. The result of your story is cash flow. The result of your story are your returns. How do I get to cash flow? Cash flow is the result of your business. Gary, you've got a 17% return. How do I get to that? So chapter 1, every EO member I've ever dealt with is an expert in chapter 1 profit. So if I said to Gary, tell me about your profit, Gary would say, for every dollar I sell, my cost of goods are 70 cents, I make a gross margin of 30, my overheads run at 20, and I make a 10% EBIT. That's chapter 1. Everyone's an expert. What is chapter 2? What's the next part of my story? And you need to know these numbers in your head every month. So chapter 2 is all about days. I need to understand very clearly in any business my working capital. Gary, for every dollar you sell, how do people pay you? How much inventory or working capital or work in progress do you need? And how do people pay us? So Gary says, I want to collect in 60 days. I want to hold 90 days of inventory and pay my suppliers in 60 days. Now I'm going to ask you all a question. If you do not know this answer, you do not understand your business model. And I'm assuming not one person in this room will know my next answer. It happens. I've done this in large corporates down to small micro business. Put up your hands for those of you who know your gross margin. Everyone knows it. Every business is an expert up here. I'm now going to ask you the next question. Do you know, Gary, EO, the next dollar you sell, how much are you borrowing to finance this? Do people know what I'm talking about? Let me explain it. I said to you, how's Gary doing? How's the bank thinking about Gary? Gary? Who can tell me Gary's gross margin? Gary's gross margin is very simple. It's 13 million on 42 million of revenue. That's about 30%. So Gary says I'm doing brilliantly, 30%. The next question is equally important, and this is where businesses stuff up. Gary, how much working capital do you borrow for every dollar you sell? So Gary's working capital, his receivables are 8.6 million, his inventory is 14.2, and his suppliers are giving him 5.5 million assistance. Gary's got $17.3 million of working capital. Gary, do you realize for every dollar you sell, so Gary's got 42 million of revenue, 17 million working capital. Gary, do you realize your working capital is 40 cents? Let me explain. 60% of companies I walk into are profitable, and they've got a very poor cash flow. And the owner cannot get his head around it. Who in this room is profitable but your cash is not? One of the first check signals is what I've just done. Whenever chapter 2 borrows more money than what chapter 1 makes, the volume is detrimental to cash. So in Gary's business, without him knowing, because we business of chapter 1 levels, Gary, every dollar he sells, he makes 30 cents margin. Every dollar he sells, without realizing, he borrows 40. Gary, do you realize cash flow is the result? Cash flow is the result of this and this primarily. Chapter 3, some of you might have, if you've invested in land and building, plant and machinery, am I getting proper utilization? A story of numbers consists of 4 chapters. Whenever you look at your business, ask yourself, what's happening in chapter 1? What's happening in chapter 2? The result is cash. I said to you earlier, I'm going to give you 3 cash flow measures that are critical to every CEO around the world. The first cash flow measure was change in borrowings. A much more important one is gross margin percent versus working capital percent. Whenever I see gross margin, I need to ask how much working capital do I need. You never ever want this to be greater than that in your business. I call it the cash flow gap. You always want gross margin to be significantly higher than working capital.
How did you calculate the working capital?
Working capital is receivables, I'll show you.
Okay.
So it's my receivables plus inventory less payables divided by revenue as a percent. And gross margin was 30, was cost gross margin divided by revenue. Working capital percent.
उसको तो बुलाना है कराची में।
Okay. Cash flow. I'm going to say something in 5 minutes' time. I promise you will change your lives forever. That's a very big statement. And I'm purely talking about finance. Cash flow is the result of growth and changes in management. Every person in this room, your management is the result of chapter 1 and 2. So what do? I walk into a company and like Gary, I say to Gary, tell me your profile. And Gary tells me that's his profile. Then what I say to Gary, let's look at good, average, and bad. So Gary says to me, if I get greater than 30% margin, I'm happy. Between 28 to 30 is average, and if my margin drops below 28, it's bad. Gary says, correct, less than 60, that's good. Between 60 to 70 is average, and if my collections grow greater than 70, it's bad. And I give this, good is a green, yellow is average, and red is bad. So I can sit with a company